welcome to the last workshop of term 1, that is corporate and commercial practice, and it happens to be the last workshop of term 1. So in case you have not subscribed, please subscribe, share, and turn on that notification button, so as you don't miss all the analysis we shall do for category B test exams. We shall have to do an analysis, so please subscribe, like, share, and comment, so as you don't miss any update. So after the incorporation of the company, there are several legal obligations that arise. One of them is raising the necessary capital to run the business. So as far as this workshop is concerned, we shall be looking at how do you raise capital. The following workshops focus on internal process of raising capital, corporate management, duties and powers of directors and company secretary in the circumstances, subscription for allotment of shares. So we shall also look at allotment of shares, and when we talk about allotment of shares, we are looking at how basically the shares have been divided. Then call on shares, share splits, rights of subscribers, and shareholders and members. So basically we shall have to understand who are subscribers, shareholders, and members. And we have the locus classicus case of the classicus case of Masur Kakire versus Incafex. Because what happened in Masur Kakire versus Incafex, Masur Kakire was a shareholder in this Incafex company limited. He sued the company on the ground that the company was being mismanaged, and he was even being denied access to the company premises as well as attending company meetings. So when Masur Kakire sued as a shareholder, then the court stated that first the director who was Msingu Garga in this case stated that first and foremost he was not a shareholder because the shares he was holding them in trust of a South African company. So of course the court had to define who is a shareholder, who is a member, and who is a shareholder, a member, and also a subscriber of the company. And they say that a member of the company is the person who takes place, who is on the register before the incorporation. Then once the incorporation is done, you become a subscriber. Then after the incorporation and the company has allotted shares, you become a shareholder. So first we have a member. Then after incorporation we have a subscriber. Then after you have been allocated shares, you become a shareholder. So that case is very guiding as far as shareholder rights is concerned. If you read it with the decision in Foss versus Harboto, in Foss versus Harboto, the court stated that it's only the company which has the capacity and the exception is that a shareholder can only sue where his or her rights have been violated, which they have called also derivative actions. So the general rule is that the best plaintiff is always the company itself, and the exception, as stated in the case of Foss versus Harboto, is that whenever the rights of the shareholders are being violated, that's when you can bring a shareholder suit. And I think we understood that from our undergraduate. So we shall be developing basically from that knowledge to understand today's workshop. So after looking at that, we shall continue and look at, of course, additionally the workshop shall dwell on how a company may raise capital. We shall look at the different ways of how a company can raise the capital, from borrowing, internal shareholder borrowing, to call on shares, forfeiture, offering redeemable shares, and offering also shares to third parties. All those ones the company can raise capital. We shall also deal with some aspects of raising capital in both private capital markets, venture capital, and private equity and public capital markets, security exchanges. So I hope that you have all heard about venture capitalists. These are, of course, funders or investors who target to finance companies that are just beginning. They target to finance startup companies, and also have a security exchange, or what we can call capital markets, that you can take a company on the stock exchange market, but it must be a public traded company. It must be a public company. We have had Airtel and MTN offering shares on the public market, offering a prospectus. So that's what we should be looking at as far as this workshop is concerned. So the aims of these workshops are A, to develop the ability to advise on corporate financing and provided under the Companies Act, develop the ability to effect corporate financing, develop the ability to draft the essential documents in corporate financing, and illustrate the ability to effect company meetings and extract the relevant consents and approvals required to effect corporate financing, develop the ability to recognize issues arising from corporate financing. So by the end of this workshop, you should be able to, one, advise on the different processes and sources of corporate finances by a private limited liability company. So basically, we are going to see how can a private limited company raise capital. One is, of course, by borrowing from banks and all that stuff. Then also we can see it can also sell shares. It can also sell shares or make calls on shares, or issue what we call redeemable and preferential shareholders. Advise on the process of effecting corporate financing through issuance of shares, shareholder loans, and borrowing from banks. Advise on the procedure of making calls on shares, forfeiture of shares, and rights of preemption. So the right of preemption basically means that once the company is going to sell its shares, then the priority is always given to the existing shareholders. Then forfeiture of shares, it basically means that if you have unpaid shares of the company and the company has given you a call to pay those shares and you have not cleared them, then you have forfeited those shares. So basically that will be it. Key skills of emphasis in negotiation, drafting, and commercial awareness. So Adong Matarinda, James Mongo, and Waswa Moto own a company called Swift and Match Pharmaceuticals. The memorandum of association reads in part, the share capital of the company is Uganda shillings 2 billion only, divided into 2,000 shares of Uganda shillings 1 billion each. The company has power from time to time to vary its capital and divide or consolidate shares in the original offered share capital into several classes, and to attach any preferential or deferred, qualified or unqualified rights and privileges and conditions. Adong, Mungo, and Moto hold 320, 170, and 150 ordinary shares respectively. So basically, you can see here that the company has 2 billion divided into 2,000 shares of 1 million each. The company has power time to time to vary its capital. So the object clause of the company is tied to one business activity, pharmaceuticals, because the shareholders want to pursue a focused single business strategy. In December 2023, the DOE agreed that the company had grown too big, and they were having cash flow challenges to maintain the company's operations needs. They needed new working capital. Their core assets is a three-story building at Kawempe Mugango, Kampala City, which houses their offices and wholesale shop for pharmaceutical products. So basically, you can see these guys have a building. They have a building. That means we can purchase this one and get money from the bank. So in February 2024, Adong approached Johnson Magezi, who promised to inject a sum of Uganda shillings 1 billion into the company in exchange for 250 shares. In excitement, Adong and Mungo transferred to Magezi 250 shares without voting rights. However, to this day, Magezi has never even paid a single penny. He keeps making promises after promise. Adong and Mungo are very disappointed, calling Magezi a scammer and wants to take away the shares from him quickly before the transfers them to third party. Adong has since landed on a good fortune and got money. She wants to buy all the shares of the company. Adong is also ready to lend the company some money at low interest rate of 13%. So basically, you can see this one 13%. That one you can do what we call shareholder loans. If the company can give some stake in the company to hold on to, and provided she's paid before the other shareholders when profits are made. So that means he wants preferential shares. She also wants to be considered as the first party to buy shares in case one or both of these existing shareholders decides to sell all part of their stake. Adong has since paid for all the shares she has in the company, while Mungo and Moto have only paid half of the money they are supposed to pay. The directors further inform you that the company is very prosperous and capable of attracting investors to buy into a good return to the company over and above its value at incorporation. Adong has introduced a new idea of issuing shares at a value higher than their nominal value. She believes that this is the best solution for the company. However, Mugo and Moto have no clue whatsoever about this aspect, and they think Adong wants to take advantage of her newly found ways to cheat them. The directors are confused by the proposals on table. They fear losing both their business and asset. They have approached you for advice after learning that you are an statutory corporate and commercial associate at one of the top city lawyer firms in Kampala. Advise the directors on whether they can get current shareholders or any external persons to bring money into the company for shares, and if so, the formalities that have to be undertaken to achieve this. So basically, how shall be looking at how do you get monies from third parties, and of course the ways here available is you have to third parties. You can do what we call, of course, you can borrow money from the bank because they have security. We have seen that. Secondly, you can issue shares. You can issue shares. You can sell shares to internal shareholders. So we shall also look at call on shares. You can, if there are any unpaid shares, you can also call on them. So basically here we are looking at three modes. One is issuing of preferential shareholders or redeem of shareholders. We have also borrowing. You can borrow from the internal borrowing, or what we call shareholder loans. Then we can also look at shareholder loans, borrowing from the bank, as well as internal shares. So advise the company how it can regain the 250 shares from Magezi. This is issuing a call on shares and then forfeiture. So you call Magezi to pay for the 250 shares, and then if he does not, you forfeit. Draft the necessary document into above. It's going to be a call on shares. Advise Moto and Mungo on whether they have any rights before more shares are given to Adongo. So we have talked about the right of redemption. The right of redemption basically means that before you do any other thing to another shareholder, then that person ought be, you first give the shares, you first give them the right of redemption to the existing shares. So assuming the company has identified an investor, Jones Mgaga, she wants to invest Uganda shillings 3 billion into the company. Exchange of 3,000 ordinary shares is also flexible and does not mind if the existing shareholders try to limit his voting power. Advise the company on the procedure necessary to access this money, and draft the necessary documents and fill in the requisite statutory forms. So basically here we can see that assuming that the company has identified an investor, Jones Mgaga, who wants to invest Uganda shillings 3 billion into the company in exchange for 300 ordinary shares. So basically here we shall look at you have to allot this person shares, allotment of shares, and then after that you sign what we call a shareholder loan agreement. So the draft the necessary documents and fill the requisite shareholder forms. So basically here we shall look at allotment of shares and also the shareholder loan. That's basically what we are going to, shareholder loan agreement and allotment of shares. Then task 2, assuming that Mungo failed to pay for his shares while all the other shareholders paid for their shares, advise the company on how to take ownership of the shares and generate capital for the company using the said shares. So basically here we look at call and forfeiture. So once the company has issued a call and you have not paid, they can proceed to forfeit the shares. Assume Mgaga's proposal to be admitted as shareholder was approved. Advise the company on the process of obtaining money from him and making him a member of the company. So basically, the only way you can make this person a member of a company, you have to allot him shares sign what we call shareholder loans, and then proceed to do what? And then proceed to register that with the company. So that's the most essential document required by the board authorizing the company's transaction with Mgaga. That would be, of course, a board resolution. That would be a board resolution. So here they were saying that that would be a board resolution. So we look at task 3, advise the company on how it can create the special type of shares being requested by Odongo in exchange for the money she intends to lend to the company. So advise the company on how it can create the special types of shares. So here we are looking at creating preferential redeemable shares. What rights will accrue to those shares? Of course, preferential treatment, including fast access to profits, among others. Then draft the documents required to execute the company's instructions to create the desired type of shares. Those are going to be, of course, a board resolution. How will the company be able to acquire these shares once it finds the money Odongo lent it? Of course, by redeeming, by buying them back. It's by buying them back, and I think we need a special resolution to buy them back. Then task 4, they are saying that advise the company on the procedure and implications of issuing shares at a higher value than their value upon incorporation. This is what we call issuing shares at a premium, and for you to issue shares at a premium, you must have what we call a premium account. What additional information would you seek from the company to effect the instructions above? At what market price do you want to offer the shares? How many shares do you have? Do you have a premium account for these shares, among others? Draft the necessary documents to effect the instructions of issuing shares at a premium, and that's also a resolution. I think it's a special resolution. So you have to understand what's the difference between a special resolution and an ordinary resolution. Because a special when you look at table A of the Companies Act, also read together with the regulations, they always specify whether what you need is a special resolution or whether it's an ordinary resolution. So basically, that's where you get those things, and you have to make a clear difference where you proceed by a special resolution and an ordinary resolution. So it's a difference between the two. A special resolution, you always need 3 out of 4 of the members present, whereas the other one is a simple majority, which could be 51%. That is an ordinary resolution. So, but in case you want a discussion which is detailed, we also have notes. We cover all category B discussions, and we cover all the 4 campuses. If you're in Mbarara, Lira, Kampala, and Mbarara, and you need a discussion group of guided students where you receive notes in time and also a discussion on the same, and you can contact me at any time in case you have any questions. Then WhatsApp me on the number on the bio, and then students pay a monthly subscription fee. So if you have, it's better you can make that investment, and we simplify your time. But if you cannot afford, then of course we can still make it. That's why we are here. Workshop 2. The aims of these workshops are to advise on the new forms of private external corporate finance, such as venture capital, private equity, and mezzanine financing. So we are going to be looking at venture capital. Basically, venture capital targets startup companies. Private equity, the investors give you money where they take in equity in your company. Mezzanine finance basically combines base debt, combines both debt and finance. So develop the ability to source capital through exercising structures of external or public corporate finances, such as public capital markets. So we shall see how do you go into public capital markets, and you have to understand that for you to go into public capital markets, then you must first turn your company from a private to a public company. You can't be having a private company and you go to do public. Advice on the roles played by the respective organs such as shareholders, regulators, and Uganda Security Exchanges in corporate finance transaction. So of course, shareholders, regulators, we have Uganda Security Exchange, we have regulators So basically, these ones are the ones who govern how companies are admitted on the stock trading market in Uganda. We have, of course, a lot of legislation the same, which basically deals with this, the Stock Exchange Market Act, alongside others. So, workshop 2 aims. The aims of these workshops, we have looked at that. Then we wrote the ability to recognize issues, learning outcomes. By the end of this workshop, you should be able to advise on the various models of external corporate financing, advise on the silent aspects of both private and public external corporate financing transactions, draft the essential documents required by the respective role players in the external corporate financing above, and address the ESCO issues. So after successful advising Swift and Match Pharmaceuticals on its transaction in section 1, the directors are very happy with you. They have further informed you that they are open to foreign business partners. There are a huge market for ARVs, which the government of Uganda intends to buy from the company. Now the USAID has been suspended by President Donald Trump, and locally made ARVs can be purchased for free distribution to persons living with HIV in Uganda. Other development partners of Uganda have agreed to step in and buy the drugs from the local source, unlike USAID, which was purchasing them from abroad. The company has met one Mr. John Stent, who is general partner of African Business Matter Fund, based on in Mauritius. Is excited about expanding their geographical portfolio to Uganda by lending to company $2 million at an interest rate of 3% per annum. However, the fund also wants a profit-sharing arrangement, power to appoint a new chief executive officer, a new chief finance officer, and 3 board seats if they are to approve their deal. The company's building is the main security being considered to supplement personal guarantees of the existing directors and shares held by the shareholders. The shares of the shareholders are also potential added collateral if needed by the lender. So the event alert managing director of Swift Bank, one CBMB, has heard about the funding opportunity and would like the fund to channel the loan disbursement to the company through the company accounts in Swift Bank so that the bank earns some fees. Is willing to give the fund a dedicated relationship manager and free corporate desk. Directors have also informed you that they are willing to issue additional shares to boost the public, so the both individual and institutional investors like NSF can also share in the success story. Advise the board on the restrictions, if any, on its powers to borrow from fund in the circumstances. So basically, first and foremost, for the board to continue to borrow, first and foremost, they have to look at the objective of the company. Is it within the objective? Yes, it's in the objective. Then secondly, their nominal capital, how much? For example, it was 1 billion. Can you borrow above 1 billion? Then second, of course, they need consent from shareholders where they're going to borrow about that. You get? So basically, those are some of the restrictions you have to look at. Assuming that you have been hired by the fund to conduct a legal and regulatory risk assessment prior to lending the company, advise on the necessary consideration that will inform your assessment. Please restrict your answers to the provisions of the Companies Act. So basically, when you hired by the fund to conduct, first and foremost, is the company incorporated? Secondly, what is their tax compliance? Then thirdly, who are its directors and what are their roles? Then also what's its returns, annual sales. So you look at those basically those things. Advise on the procedure steps of venture capital financing as a form of external corporate financing. Ensure that you address the protection of all parties in the transaction. So basically, venture capital, we have from the negotiation to a sketch agreement up to the time you sign what we call a venture capital agreement. But it's a step from negotiation to signing a draft venture capital agreement, and then finally having a venture capital agreement. From the time you identify the possible venture capital, advise the procedural steps of venture capital financing as a form, prepare a brief legal opinion for the managing director of Swift Bank on the pros and cons of venture capital in mezzanine loans and the extent of corporate financing in Uganda. So basically, when you look at venture capital, they are targeting growing companies, whereas mezzanine is a combination of both debt and equity. So venture capital, they have first and foremost, they have a lot of high interest. Then secondly, you tend to lose, of course, independence. Now you have control from other external parties. Then thirdly, it's not always, if you are paying always annually and you have a lot of conditions. Then mezzanine, there is always a lot of high interest, and also you tend to lose control of your business. But once you understand what mezzanine is, it is a combination of both debt and equity, whereas venture capital, it targets young or maybe startup companies, whereas private equity, they just give you money and they want equity in your in your business. Task 2, the directors have also heard of financing instruments called convertible notes and simple agreements for equity, appraise them on the meaning of commercial applicability of these instruments. So basically, when we talk about simple agreements for equity, these are and convertible notes, these are one of the ways how a venture capital agreement can be structured. So when you look at convertible notes, they are automatically converted upon happening of an event, whereas simple agreements for equity, they will also, for example, they will say that after you take your company to initial public offering, then we shall take our equity. So basically, the two they almost mean the same thing: convertible notes and simple agreements for equity. But the difference is that one is long term, the other is short term. Assuming the company has stabilized and is cash flow positive but still has senior debt, however the company wishes to expand further, advice on the form of financing it can undertake. So basically, you have 3 forms of financing. One is mezzanine, secondly is private equity, and third is venture capital. So here they are saying that assuming the company has stabilized and is cash flow positive but still has senior debt, however the company wishes to expand further, advise on the form of financing it can undertake. So basically here, since it has a debt, they can go for both mezzanine, because mezzanine helps pay debt and also gives you equity. Assuming the shareholders are tired of the business and want to exit, advise them on the possible exit strategy that can bring new financing to the business and keep running as a going concern. So basically, you can the shareholders can take the company to public. Once you take the company to public, you tend to lose. It remains, but you as shareholders, you can even sell. Task 3, prepare checklists for directors on the requirement of the principal document they will need to take the company public. Basically, that document is always a prospectus. It has a statement from auditors, financial accounts from auditors, all that things. Then to advise Swift and Match Pharmaceuticals Limited on how it can issue shares to existing shareholders without requiring the shareholders to pay for the additional shares. So basically here they can do what we call bonus shares. They can issue bonuses to the shares, advise the fund on the security perfection requirements regarding shares pledges in Uganda. So here we shall be looking at how do you register shares once you have charged them in the company, and the Company Act basically provides how you can perfect those shares. Then when we look at task 4, discuss the respective role players in public listing transaction. Public listing, we have of course the Uganda securities market, we have the role of shareholders, we have regulators, directors, accountants, and auditors. Both of them have a role to play when we are dealing with public listing. Advise the company the process required to become a public company. So when you're turning a private company to a public company, you have to look at the Companies Act. I think we have a section which basically provides how do you turn a private company into a public company when you look at the Companies Act. Then 3, advise on the tax implications of the anticipated transaction between Swift and Match Pharmaceuticals Limited and the fund. So of course we have to pay what we call withholding tax and the income Tax Act, among others, and also capital gains tax, For assume that the senior partners at your law firm are considering purchase of shares from Swift and Match Pharmaceutical Limited as soon as they are available to the public, prepare a brief opinion. So basically here you are going to look at who are the directors, second, what is their who are their competitors, thirdly, which products does the company deal in, and also its financial statements. Basically, this due diligence you have to make when you are going to do what? To invest. So we see how cases here. Then when we go to workshop 3, assume that before Swift and Match Pharmaceuticals Limited went public, it had obtained a series of loans from Adong as a shareholder in the table matrix below. This was upon written request from the managing director of the company. Adong deposits these monies on the bank account for the company by, and his proof, he also has the email correspondence with the managing director. Upon perusal of the said schedule, you have also seen email correspondences between Adong and Moto, where Businje is acknowledging that indeed Adong lent the company funds for the above activities. So basically here we are dealing with how do you deal with rights of the aggrieved shareholders, and I think when you look at section 243 and 244, they provide for a petition. So basically here we shall be proceeding by petition in workshop 3 for the rights of the aggrieved shareholders. So basically that's a brief analysis of the workshop. Please subscribe, like, share and comment, and in case you want a thorough discussion, this I was just giving from my head, I have not researched, but of course you expect something better when we have discussed and researched, but basically this is a mere guide and I hope it's very helpful. But in case you can afford to pay 100,000 per month and we make your life easy at LDC, we become your research assistant. Please WhatsApp me on 075 67 284 075 67 284, and then we can add you in that mastermind group in case you can afford to pay 100,000 per month. So students receive notes, they can contact me at any time. We also have discussions of all category subjects. We shall be discussing category B, among others. So it's a very good group in case you can afford. But if you cannot afford, then you have to pay with your time. You can do the simple slides and still we shall be able to make it. So please have a blessed evening. We remain the pass bar.